Onto your markets news now. Asian stocks were on the up today. This as investors were hopeful that key central bankers could become less aggressive on early signals that previous monetary policy action had begun to temper inflation in some regions. But positive sentiment could be short-lived depending on what outcomes come out of the OPEC Plus meeting later today, which is said to be mulling cutting between 1 and 2 million barrels of oil a day. Such a move would likely put upward pressure on inflation. The Nikkei share average closed up 0.5%. The Hang Seng Index jumped by a whopping 5.9%, while in mainland China, the Shanghai Composite Index bucked the trend. It came down by 0.55%. Over in the United States, Wall Street rallied for a second straight day to end higher on Tuesday after softer U.S. economic data and a smaller than expected interest rate hike by the Australian Central Bank, stirring hopes that the Federal Reserve might cool its aggressive raising of rates. U.S. jobs earnings fell by the most in nearly 2.5 years in August, a sign that the Fed's mission to tame inflation by tightening policy was working to slow the economy. The S&P 500 gained 3.06%, the Nasdaq Composite gained 3.34%, while the Dow Jones Industrial Average rose by 2.8%. Onto our local market now. The JSE trading weaker at this hour. The all-share index has shed 0.9%. It's currently standing at 65,728 index points. The industrial 25 index is 0.4% weaker. Financials are 0.6% down. Markets in Europe are also in the red. Britain's FTSE 100 has declined by 1.2%, and the Paris CAC 40 in France is down at 0.7%, and Germany's DAX is down by the same margin. Looking at commodities, gold is trading at $1,709 an ounce and platinum at $917 per ounce, while the price of Brent crude oil is trading at around $92.35 a barrel. The rand is trading at 17.77 to the dollar, 20.20 to the pound, and 17.63 against the euro. Well, to unpack the markets for us, I'm joined by Chantal Marks. She's from FNB Wealth and Investments. Thanks very much, Chantal, for joining us. Should players be cautious as markets generally have seemed to recover, even though our local market is on a downer at the moment? Should people be cautious given the fact that all the variables that cause markets to fall substantially are still there?
Yeah, Nompu, I mean, as you mentioned, our market is already reflecting a bit of a more cautious stance today. The only reason why we saw Asian markets perform so well this morning is because we had some public holidays that interrupted trading over the last few days. So they were really catching a bid because they were playing catch up relative to the rest of the world. But you can see in the US futures market as well, investors are standing back a little bit and reassessing their assessment of the market over the last couple of days, and looking for more clues that inflation may have peaked and that reserve banks may indeed be pivoting, because that was what the initial rally was all about. The expectation that interest rate increases might slow down and may even reverse sooner rather than later.
So, of course, the markets will be keenly watching the OPEC Plus meeting. They're going to be coming out with their deliberation later today. The rumor is that they could cut between 1 and 2 million barrels of oil per day. How much of a concern should that be to the international market? More so because, of course, we've all been battling with higher inflation.
Yes, I mean, if they're going to cut production, that means that there's less oil available in the market, and that could put upward pressure on petroleum and gasoline prices, chemical prices, and a whole host of other prices. And while that isn't necessarily part of a core inflation basket on which interest rate changes are based, they are pass-through impacts. So if they are going to push up, to push up prices by cutting production, it could have longer-term consequences for the inflation outlook. And that's probably also why you're seeing investors taking a bit of a backseat today.
So, Chantal, we've been hearing about major banks, the possibility that some major banks might actually fall. You know, people are talking about a possible Lehman Brothers moment, the likes of Credit Suisse, people are watching very closely. What are some of the dynamics there? Just tell us, and how concerned are you about this?
So I think it's completely different to the Lehman Brothers story, because there isn't one massive specific external factor that has driven this company into a bit of a bind, if I can put it lightly. Really, it is their internal controls that have failed them, and they really need to start looking at restructuring that business. One of the concerns that investors have is how they are going to fund a potential restructuring, but we know that is going to come. It's a pretty large bank. It's a very sizable bank within the Swiss and European banking space, and it will have massive impacts on the rest of the world should the fears around Credit Suisse actually materialize into something more serious. For that reason, though, I do think that there will be intervention if it actually comes to that. But for now, the concerns are more about how they're going to fund the turnaround of the investment banking business, and not necessarily that they're going to collapse. I think that fear has faded somewhat. The bank itself is still facing a host of challenges. I just looked at the headlines on Bloomberg, and I see that there's a bit of an exodus in bankers in their Hong Kong division, as well as some of the executives in Switzerland as well.
Well, it sounds like we could talk about that particular subject for half an hour or so, and so we move on. Let's take a look at our local economic fundamentals. I mean, they look quite bad, especially when we continue to experience load shedding at a high stage of, stage 4. Transnet workers threatening to go on strike from tomorrow, if I'm not mistaken. And of course, that's a very strategic operator for our imports and exports, etc., etc. How does this translate in how people are choosing to invest in our local capital markets?
So it's actually quite interesting at the moment, because there are a lot of different dynamics at play. You do have a situation where near term you're going to be facing electricity constraints, which is obviously bad for economic growth. But then you get announcements like we saw yesterday from Anglo American saying that they're going to invest a whole lot of capital to build capacity in electricity generation for themselves, to the extent of 3 to 5 gigawatts of power by 2030. That's a massive investment that's going to come into the South African market. And 3 to 5 gigawatts is basically stage 3 to stage 5 load shedding. So there are green shoots when it comes to the electricity generation story. And I think that our economists are now factoring in what Anglo American is doing, and what a lot of other private businesses are doing in their expectation for private sector investment over the next few years. So it could look better if you look 2, 3, 4 years down the line. But unfortunately, currently, the fundamentals really are still quite soft. And I mean, as you mentioned, labor disputes don't really help matters. I know that Transnet has now upped their offer. Hopefully, we'll be able to avert that, because Transnet really also working incredibly hard in terms of fixing its business and opening up its business to the private sector and to private sector investment, which I think can really unlock great opportunities for that SOE as well. So there are things happening, and the good thing about capital markets is they tend to be forward-looking. So once we start seeing shovels in the ground, it may start translating into good prospects for the South African market.
Well, on that positive note, thank you very much, Chantel. Chantel Marks, she's Head of Research at FNB Wealth and Investment.